Take a look at the biggest corporations on Earth. The tech giants building our phones, the airlines flying across the globe, and the banks holding our savings. These firms compete ruthlessly for every dollar we spend. Yet the public shareholder reports for these fierce rivals tell a different story. The names BlackRock, Vanguard, and State Street sit at the very top of the list for almost all of them. It seems impossible. How do the exact same three names appear as the lead shareholders for nearly every major corporation in the world? On paper, it looks like a three-headed oligopoly has quietly purchased the entire global economy, gaining control over everything we buy, use, and consume. Resolving this paradox requires following the money trail away from the names on the list and back to the original source of the capital. BlackRock, Vanguard, and State Street are asset managers. They function as financial administrators, overseeing trillions of dollars for millions of different clients. Their core business model involves managing money on behalf of outside parties. They are stewards of capital that originates outside their own corporate offices. The vast majority of this wealth comes from everyday retirement accounts and massive pension funds. This is the collective savings of teachers, firefighters, and healthcare workers. Individual retail investors contribute the rest, moving portions of their biweekly paychecks into personal savings and exchange-traded funds. This diagram shows the scale of that aggregation. Millions of small individual contributions funnel into three massive central hubs, creating immense buying power. These firms act as administrative pipelines. The financial weight they carry in the market is a direct result of pooling the modest savings of the general public. This raises the question of why these pipelines distribute that money into every single company instead of picking a few specific winners. The strategy is called passive investing. Rather than trying to beat the market by guessing which stock will rise, these funds use stock indexes to match the performance of the entire market at once. It's the difference between betting your entire budget on a single cereal flavor or buying a variety pack. Spreading the investment out reduces the risk of one bad choice ruining the whole plan. Spreading money across hundreds of companies protects the investor. If one business fails, the broader market's growth can still keep the retirement fund on track. The stock index acts like a rigid template, forcing incoming capital to be divided among hundreds of company nodes automatically. As index funds grow, the record volume of capital moving through these templates forces the resulting ownership stakes to swell. This ubiquitous ownership is a mechanical byproduct of the index system, a mathematical rule designed to protect everyday retirement funds. There is a clear operational line between managing an investment portfolio and running the day-to-day business of a corporation. Holding shares on behalf of a client provides the legal title, but it does not grant an asset manager the power to design products or hire staff. These managers do participate in proxy voting on major shareholder issues. However, their primary legal mandate is to track the index accurately for their clients, not to act as corporate directors. An asset manager's name at the top of a list indicates who holds the legal paperwork for the millions of people actually providing the capital. The image of three corporate overlords controlling the world's economy changes when you look at whose money is actually in those accounts. The true owners of the world's largest corporations are the millions of people holding shares through their 401ks and index funds. The titans of Wall Street are moving capital that belongs to you. But what if one single person tried to buy an entire sovereign country? That is the subject of our next documentary.